the slides? Yeah, this is the key thing. Warren Buffett is one of the legendary investors in the world who's done very well, and ethical investing, has followed a very strict discipline in whatever he does. And it's, I mean, good. Many people follow him. You learn a lot from him. Next, please. See, you may say you're putting money in the bank. I have money in the bank, I've saved everything. But what about inflation? Money in the bank does not grow. The mouse here is the inflation which goes on eating all your money. Next, please. Solution, you have to safeguard against inflation. And obviously, the earlier you start, the better. I think we had discussed it earlier, a month or a couple of months back, when we had done a session on investing. Power of compounding is something which you have to accept and subscribe to. Next, please. Sorry, I'm going so very rapidly, but the idea is to just give an overview and then we'll come on the mutual funds. See, as anything in life, one has to have a goal. Even when we are retired, even when we are not professionally occupied as such, but I think there has to be a goal in what you do. I mean, I also retired 2 years ago, but my goals are different. I mean, I try and do some things, keep myself busy, and financial goals are set, so I'm not too worried on that. The, sort of little bit on autopilot mode. Next, please. What are the various options you have? We've discussed all these, and the one in green, mutual funds, this is what something we will do. Saleh, is there some way where I can control this, or you only have to do it? Next, please. Hello?
Just give me a second. Let me see if I can give you control. I'm not able to. I know. Just give me a second. Just give me a second.
Forget it. It's all right. Let's move on.
Just 1 second. I should be able to solve it. See if you can do it now.
No, it's not moving. One second. No. Okay, fine. It's moving now. Not with the mouse, with the down arrow key. Okay. So we need to make our investments work for us. Inflation, ensure that you have an income coming in. Be liquid, so you don't get locked in. Like property is something you get locked in, you can't sell whenever you want to. It grows in value, and when you sell it, you get a reasonable and a fair value and a low cost. So this is what we are doing. Sorry, Saleh, again back to you. It's not moving. Okay. Asset allocation is, we had seen the various assets, right? Equity, debt, bonds, property, gold, etc., etc. So how do you balance out your money among these various assets? It's a very nice depiction which Saleh has done here, is of a mixed balanced thali, which has a various food items, and you choose and select and you have those. Similarly, with your money, you select where you want to put your money, depending on what your goals are and what your profile is. I'll come to that. Next, please. Mutual funds, the focus of today's discussion. Okay. Now, in this, I mean, you can read this. I don't want to repeat it, but mutual fund, essentially, in very simple terms, is mutual, as the word means. You are pooling together your resources with and giving it to a professional fund manager who will manage the money for you for a fee. Okay. There is no concept of assured returns. We had that earlier when we had those MIP, which Unit Trust of India gave you. They gave you assured returns, and the government of India, then they stopped it. So it all stopped at the end of it. No, Saleh, it doesn't move. I can't control it at all with the keyboard or the mouse. So Why is it cost efficient? Because you are pooling your resources, as the graph here shows. A fund manager, they invest in stocks or securities, you help generate returns, which you give to the investors. Okay. Obviously, it'll be slightly costlier than investing on your own, but because you're paying a fee. I mean, investing on your own, I mean, you're not giving it to any professional to manage your money. Is it clear so far, or is there any questions? Hello?
Yeah, it's clear.
Or has everyone gone to sleep?
No, no. We are listening.
Yeah. Okay. So why invest in mutual funds? You have these, it is well regulated. You're a professional managing your money at a very low cost. It's transparent. You get to know your investment value on a day-to-day basis. You get your money the next day, provided it's within the 3 o'clock cutoff time. And it's something which is reasonably safe. Nothing can be 100% safe, but this is reasonably safe. Next, please. Next, yeah. Structure of a mutual fund. I mean, this is more technical, but essentially you have the sponsors, you have a trustee, then you have the asset management company which actually runs the mutual fund. The investor, the custodian, is the one who looks after your investments. Okay, you like there's the bank where the shares lie and all. Then you have the agents, distributors, bankers, fund accountants, and R&T, register and transfer agency, who transfer the shares, who manage the ledgers or accounts. Okay, let's say Mr. A has sold today and Mr. B has bought, and Mr. B has sold and Ms. C has bought. So all a record of that is maintained in the registrar and transfer agencies' offices. Next, please. Sorry, I'm going very fast on this, but you have various types of mutual funds, okay? You have open-ended funds, meaning you can come in and go out at any time. Closed-ended means you are, the scheme is open. After that, it shuts down, and then you can't lock in, maybe with a penalty, but mostly no, you're locked in for X amount of time. Interval funds are like the periodic times they come in and they come for subscription or they redeem money. Active funds is one which actually manages the money on an active basis. Like you invest in shares or in bonds, and they are monitoring it, investing in it, and going ahead and doing things. A passive fund is something which tracks something, like an exchange traded fund. It tracks the indices, right? So it is not investing directly, it is investing in the index, which is dependent on the movement of the shares and the prices. Then you have growth funds, income funds, and hybrid. Hybrid is a mix of growth and income. Okay, growth is where you're focusing on delivering capital appreciation so that your value of your investment grows. Income is where you get a regular income from people, and hybrid is a mix of the two. Your portfolio can comprise of equity funds, debt, hybrid, and liquid funds. Other types of funds, these are various types. You have a gold exchange traded fund. I mean, you don't buy gold, but you get paper or electronically gold which you have invested in. Okay, I mean, so you don't get gold, you get a physical certificate or electronic certificate saying you hold X amount of gold, and that tracks your gold. A retirement scheme, overseas, invest in overseas companies, right? And fund of funds is a fund which invests in other mutual funds. Okay, people come up with all sorts of things. You have funds also which invest in weather and derivatives and agricultural commodities and all sorts of stuff. It's just a creativity which people come up with. Unfortunately, in India, you have severe restrictions. I can't come up with, let's say, investing in horses or something. Okay, but in overseas, it's very likely they can come up with something as long as they can quantify it, explain it in a reasonable manner, and they do it. In fact, derivatives is something which is, as a word, derived from something. And you have contracts which invest in weather. Okay, it's pure speculation. So you have a derivative from weather, how the weather is moving, the forecast, and what are the temperatures, and investments go on that. I mean, crazy stuff happens. So it's best avoided unless you're an extremely sophisticated investor, which I guess most of us are not. And I put myself in that category also. Next, please. Okay, now category, we have seen this earlier. So I think we can move next straight away. Equity schemes. As the word equity means, you're investing in equity shares, which are listed on a stock exchange. I mean, you also have private equity or unlisted equity, but that a mutual fund normally does not come. That goes into stuff like venture capital and private equity. Okay. So here your multi-cap, which invests in multiple capitalization of equity shares. You have large cap, small cap, mid cap, etc. So you have a large cap fund, large and mid cap fund, a mid cap fund, and a small cap fund. A multi-cap would be a combination of all these. Okay. The next, please.
Arjun, can you just explain what a large cap fund is?
See, you have categories of classification of market caps of stocks. Okay. There's unfortunately, to the best of my knowledge, no standard categorization or classification of market cap. It can be, let's say, 25,000 crores of market capitalization. Okay. It can be, mostly it is 25,000 plus becomes your large cap. 10 to 25,000 will become mid cap. 5 to 10,000 will be small cap, and below 5,000 will be micro cap. So these are the broad categories. It's on the market capitalization. Market capitalization means the value of the shares listed, of the total shares listed on the exchange. Like when you say Reliance has 100,000 crores of market cap, that means all its shares are valued at 100,000 crores. Okay, because you take the price of a share, let's say 100,000, so 1,000 and into 100, so that is how it will work. Okay, and then you have dividend yield funds, which focus on paying out dividend every quarter or every month, whatever the case may be. Value fund is essentially looking at growth. Contra fund, which follows a contra style, in the sense market is going up, these buggers will be shorting it. Okay, focused is maybe you have 20 stocks or 15 stocks. Then sectoral thematic are like pharma sector, steel sector, consumer sector, fast moving consumer goods, automobile sector, various. And sectoral and thematic fund are, that I've explained that, an equity linked saving scheme. So this is mainly for tax and all, which the government of India has sort of introduced. Next, please. Am I going too fast? Is there any question which you need clarified? Hello?
You all want to take a quick break to actually think about it and ask more questions, or do we want to just go along? We will have a long time for question and answer.
But if somebody has anything on these, I'm happy to answer it right away. I leave it to the audience.
The slides are going very fast. Make them a little slow. Before we can finish reading, the slide is gone.
Yeah. Okay.
Vanidhari, the reason is the slide is just for, it's not meant for the entire reading. Actually, you should be listening to what Arjun is saying. The slide has much more information which can be read later. We can actually put these slides onto our website.
I was about to suggest that. So you can come back to these slides later. And I'll also make one more suggestion here, that in case you have any questions or something afterwards, please direct them through Saleh. Saleh, if that's okay with you, and I'll be happy to answer them for you.
Absolutely.
Because I mean, I do understand we are going pretty fast, but the whole rationale being I covered some things earlier, and I don't want to bore the participants, number one. And number two is I want to leave more time for question answers. So if you have any question answers, we'll take it up maybe in the next 15-20 minutes or so. So then you will have time, next 10 minutes I'll try and do it. So you have more time to have your doubts clarified. My main objective is to have any doubts in your mind clarified, because I'm sure you will have multiple questions. Now, these are the categories of debt funds, okay, which give varying returns. Obviously, a long-term fund will give you higher returns. These are all short duration, okay, which are mainly liquid, and liquid returns are normally lower than long term. Because the person who borrows money, if she or he knows that if I'm having the money for 10 years, he'll probably like give you a higher rate. If he has only, let's say, for 1 day or 2 days or 1 month or 3 months, the interest rate paid out will be lower. Next, please. Yeah, here you have medium and medium to long and long. Dynamic, which changes according to duration as well as according to the interest rates also, which change, the floating rate fund. Then corporate bond fund, which invest in company bond and credit risk. Okay. I mean, these are various types. Essentially, these are funds which give you a return. It will not focus on capital appreciation unless the interest rate drops. Then, or let's say the interest rate goes up, then the value of the bond will slightly drop, and if it's vice versa.
Arjun, do you want to just stop here and explain whether this is equal to a fixed deposit in a bank or a company?
No, it is not equal to. No, it is not equal to a fixed deposit in a bank. It's a very good question. The reason being, I'm sorry. A fixed deposit gives you a guaranteed return, let's say 5% or 4% or 4.5% or 3% for a fixed period of time at fixed duration. A mutual fund, there is no guaranteed rate of return. It depends on what the fund earns. After deduction of expenses, then they will decide how much to pay out. Let's say the fund is earning 7%, the expenses are 1%, then you can get about 6%. And next year it could be 5%. The year after interest rates go up, it could be 8%. So it's extremely, there's no guaranteed return. That is the fundamental thing you have to understand, number one. Number two is for a fixed deposit is mainly with a bank or companies. Okay. And you have fixed, companies have fixed amounts. Banks, of course, you can have any amount. There's no restriction. But mutual funds today are as liquid as a bank fixed deposit. In the sense, you can get your money in 24 hours. Like before 3 o'clock on a working day, if I apply to the mutual fund by I want X amount of money, and provided your bank account is registered with the mutual fund and linked to the mutual fund, you will get your money the next day by about 9 o'clock. It's that easy. Bank fixed deposits, I don't know why some banks have stopped it. ICICI Bank, they called it something known as sweep in and sweep out. HDFC Bank still has it. And I would strongly recommend all of you to check if your banks offer this. What happens is you specify, let's say minimum above 1 lakh of rupees, whatever money is there on, let's say HDFC Bank, I will share my example, every Monday. If money above 1 lakh is there in the account, it is straight away taken to a fixed deposit. That means swept out, okay, to a fixed deposit. Now let's say my bank balance is 1 lakh of rupees. I have to make a payment of 2 lakhs of rupees. So what do? I simply write a check for 2 lakhs. I don't go and break the deposit and all. The system automatically breaks it and they sweep in 1 lakh of rupees. I have 1 lakh, if the bank has a balance, 1 lakh money moves in from the fixed deposit. So it becomes 2 lakhs and the check is honored. Okay, at times I have had negative balances, like today. I had to make a payment and my bank balance has gone into negative. My savings bank account. But the reason I'm not worried is because my fixed deposit, they'll break the fixed deposit and the money will move into my account and I'm not paying any interest on it. Okay, please remember this very important fact. Other banks will try and tempt you, which at least I am personally against it. They say, no, why do you want to do this sweep in, sweep out? We will give you a loan against, automatic loan against your FD. Now, my point is simple. Why the hell should I pay you interest for using my money? In a bank fixed deposit, sweep in, sweep out, what am I losing? I'm losing the interest. And I don't think I'm being charged any penalty for premature withdrawal because it is sweep in, sweep out. I'm not committing to the bank, I'll give you money for X amount of time. Whatever excess money, I will give it to you. I need the money, I'll take it back. Obviously, you take back only what the limits you have of FD. If limits of you have a fixed deposit of 10 lakhs and bank balance of 50,000, you can't write a check for 11 lakhs. There's no money. So bank will dishonor that check. But if you write a check for 9,50,000 or even 10,50,000, it will be given. Provided, and then there may be a charge for, minimum balance or whatever. Because banks want minimum balances to be maintained. All these things are now become different. But otherwise, they give you, no, your bank deposit is there, 10 lakhs, we will give you 9 lakhs, 90%. So whenever you want to withdraw, on that 99 lakhs which you withdraw, you're paying interest. So please, at least I would not do it, and I've never done it. The bankers have tried to explain all this nonsense to me. I've said, boss, I'm not paying interest on my money here.
Arjun, another question on debt mutual funds. Do you get a return higher than a bank deposit?
You normally should, except for short-term funds and overnight funds or money market funds.
So just to
you should maybe 0.5% to 1% or 1.5%. Don't expect more. And this is taxable. There's no tax free.
It is as liquid as a bank, or nearly as liquid as a bank, and
nearly as liquid as a bank.
It may give higher than the bank.
It
correct?
Does give higher than the bank, the long-term funds.
Okay, thank you.
And you can get your money the next day. See, if I withdraw, I'm getting my money by 8:39 in my savings account. So I can issue a check straight away or do a bank transfer. These are the various types of fund. Gilt is government securities. Floater is they have a floating rate instruments, they invest in that. Your government has also floating rate. Don't have a fixed rate. Let's say the rate of interest is set every 3 months, every 1 year, every 6 months, whatever. Like you have the LIC and the Prime Minister's Senior Citizen Savings Scheme, where the interest rate is set every 6 months. Currently, it's 7.4%. Okay. And if you're not invested in these two, I would suggest, please invest in, with any bank, Senior Citizen Savings Scheme, up to a maximum of 15 lakhs, and Prime Minister's Vikas Yojana, issued by LIC, it's a policy, up to 15 lakhs maximum. LIC gives you interest every month. I have opted for quarterly interest in a bank fixed deposit. Okay, hybrid schemes are different types of security, equity and debt, essentially. So what they try and do is give you capital appreciation from equity investments and interest income from your debt. Like the company in the mutual fund has invested in shares, hopefully for capital appreciation. So you will get some dividend on it also, but that they may or may not pay out. And in the fixed income instruments which are there, they'll invest in bonds, government bonds, other securities, where you get a fixed return. So here the benefit is you get the scope of increasing your capital as well as a regular income. So you can look at this. I think let's move ahead on this. Yeah, let's skip this also, solution oriented. I mean, that's all, let's skip this. I want to focus more on, these are the documents which one needs to see, fact sheet, okay? This is the details which you will get from a mutual fund. They give it to you every month, so you know where your money has been invested, which shares, which bonds, how much return have you got. Everything comes in this one sheet. So it's very important. Plans and options, okay. Now these are again something which you can move. Okay, fine. One key thing here. A direct plan is if you are investing directly without any broker or distributor or agent. So, okay, the cost will be slightly lower in this because the mutual fund is not paying out any commission to a distributor or a broker. So you have to judge, you take a decision where you want to invest. If you have a distributor or agent, she or he will guide you where to invest. But again, I would be, without being critical of anybody or any profession, my humble suggestion to everyone is please follow the principle of Ronald Reagan, the ex-president of the USA, trust but verify. Do not get blindly carried away by whatever anyone tells you. Unless, it's your close family or children or a very close friend or somebody. But with the agents and distributors, Nothing wrong with them. They're professionals. But one has to safeguard. It's your money end of the day. For God's sake, please check and recheck before parting with your money. There have been instances where I know of a case where ex-colleague of mine, they were switching every month. Why? I'm making money. Fine. Your mutual fund value is increasing. But by switching every month, you are paying something known as an exit load, a charge for getting out of the fund. And the broker is getting commission every time you're buying something new. After 3 years, he realized he had lost more money than what he could have made by sticking to the fund. And that all these guys don't tell you. See, when the going is good, everything is good. But today we are in very volatile times. Earlier, your stock markets never moved so fast. You had a cycle. Today, you have a cycle which, it sort of comes in what, how do I put it? Let's say up, down, right? The cycle. These cycles used to take 5 years, 6 years, 7 years. Today, you go through the up-down cycle in 2 years, in 3 years, in less than a year. Like we witnessed in 2020, when the pandemic struck, everything went down. Less than a year, you are up at the peak. Again, you're a little bit down, again, you're up. So this is something which you have to be prepared for. Honestly, I don't
do you want to answer a question, or you can actually say no, because this is a difficult one. Would you, if I had to ask you, give me who should be my financial advisor? I don't mean tell me the name of the person or the institution, but should I use a bank as my financial advisor? Should I do a private guy? My chartered accountant as a financial advisor. Anyway, I'm paying fees. The fees are being collected from the mutual fund house. Who should be my financial advisor?
Depends who you're comfortable with.
Okay.
See, banks, I'm a little bit skeptical because a bank employee has targets. Saleh, you should know that. They have targets to beat, and there can be instances of mis-selling. Okay, or mis-selling means giving you wrong advice or wrong information or suggesting wrong things because they have a target to meet. They've committed to the mutual fund house. The fellow has his bonus coming in, his review coming in. So he could give you something which is not really suited for you. I know of such instances, and even private people do that.
Can I ask you a question, please? Can I ask you?
Of course.
Yes.
Please, go ahead.
The bank priority manager, can we trust them completely?
No.
No, huh?
No.
Why? Why?
They have their own targets to meet, that's why.
Okay.
Achha. I also have bank priority managers, but they know enough not to fool around with me. But the point is, do take the advice, but I wouldn't be guided 100% by a bank manager.
Then whom do we ask?
Even if you have some private person, if you have, or some friend or a family member, cross-check. I'm not saying, please hear me very carefully. I'm not saying don't trust your bank manager. Okay, the bank executive. Please listen to what they say. They do have a lot of information and knowledge. They're trained, but do not trust them blindly. That is my humble request to you.
Yeah. Okay. Thank you.
Fundamental principle in life: don't trust anybody blindly today.
Okay. Thank you.
Yeah. Next one, please, Saleh. And then we can skip this here. This is okay. How to invest? Fine. I'll just run through it quickly. See, as I said, you can invest directly, or you can go through an agent. Essentially, what you need today is Aadhaar card, PAN card, and a bank account. Okay. And they'll ask for a PAN card, but they want to know you're a taxpayer or not. Aadhaar for address proof and other proof, and a bank account. And of course, photographs and all those documents are there. Now, this can be done online also, or you can do it physically also, or through an agent. It can be done online. There is no problem. Okay.
And just to tell everybody, this is exceedingly easy and standard.
Yeah, it is.
Easier than opening a bank account.
Saleh, I think you've done a session on net banking and all these forms and all, right? If I recall, you had
We
shared
did
this
it
with
about a
me.
year ago. Yes, we had done
Yeah,
it
about a
about.
year ago, if I recall. Yeah, yeah. Maybe you can ask that person to do it again.
Yeah, that is actually the
Maybe
plan.
a suggestion from my side. I mean, I'm being frank about it. But it will help a number of people.
We'll be trying to do it in a month's time.
Great.
We Karishma to do it. Yes.
Yeah, I mean, I remember that you had told me. Okay. Now, physical mode, online mode, okay. That same like equity shares and this you can have. How to invest, I mean, we have it on the web, people can go through it, okay. Let's not waste time on this. Let's not spend time on this.
Arjun, let's actually, just for everybody on redeeming. How would you redeem your FD? You'd go to your bank with a form, you give it to your bank guy, and the next day or the same day, they'll give you your money in your account.
Or you can do it on net banking.
It's exactly the same thing, even in a mutual fund.
Or you can do it electronically.
Yes, you can do it electronically, you can do it online, you can do it offline, you can do it physically. It is as simple as that.
And mutual funds, let me assure you, have enough protection built in, okay? They'll ask for a folio number, they'll ask for your PAN card number or something. Then they will send you an OTP, one-time password, which you key in before you log in. Then you log in, so you see your investments. Let's say you have 2 schemes. You want 5 lakhs from one scheme. Then when you put that money for redemption, again, they will give you ask you for an OTP. They will send it to you. It shall come on your mobile phone and your email. Then you enter that. After that, only your request will be accepted. So there are enough safeguards built in, but I have only again a very simple suggestion. Please be very careful about sharing your phone and your emails with people. There are enough scams going around, enough software is available, they can hack everything and they can impersonate you and take your money. There are enough horror stories. So please be very careful, and a password, don't keep your name, don't keep 1, 2, 3, 4 and all that nonsense. Keep it complicated, write it on a sheet of paper. When I do that, I save it on my phone and it goes in the cloud. I mean, I'm sharing what I'm doing, but you have to do that. You cannot remember these passwords, and don't keep the same password for everything, for God's sake. And change it every 2, 3 months. I mean, a bank forces you to change every 3 months, so you can safe on that. But be very careful of this, because it's so easy and people will call you. And remember one thing, no bank or a mutual fund will ever call you from a mobile number, unless it's a relationship manager whose number you will have with you. You will get calls. I get N number of calls. I'm calling from HDFC Bank. You're getting a credit card. I said, don't talk nonsense. The bank is not going to call me from the mobile phone. These are calling agents. Okay. I'll again share my example. I was withdrawing my Provident Fund money. I got a call from a mobile number. No, we want your other number. We want this. We want that. I said, bullshit. You're trying to cheat me. So I called up my agent. He said, for God's sake, don't give anything. I said, obviously not. I realized immediately. It's a con. Many a time I get a phone. You have invested, you have a life insurance policy with Bajaj. I don't have any policy with Bajaj. You have a policy with them. So please give us the details. And I go jump in the lake, I told the Baba. Short of abusing him, as you know, you can't slam the mobile phone down. And N number of calls you'll get. You want to trade in the market, this, that, we'll give you very low rates. I told him, one guy, I was there sitting free. I said, let me pull this joker's leg. I said, fine, we will trade. How much will you trade? I said, minimum 5 crores. Below 5 crores, don't talk to me. And I said, how will we trade? He said, 60% profits are mine, 40% yours. Loss you make is your problem, I said. Then I put the phone down. Fellow not call me after that. And even if you block the numbers, I don't know from where they get these damn numbers from, and they go on calling you. Like invariably, once a day, twice a day, I get a call from Ludhiana, from Chandigarh, from Bangalore, offering me a loan. I don't want a loan. I block it, some other number comes. Our call blocking system is horrible. So I strongly recommend, please be very, very, very careful in discussing numbers, discussing finances over the phone and on email. Ask that person to come and meet you. I mean, I'm still old-fashioned enough who believes in a physical meeting. And of course, most of the stuff goes electronically, but those are people whom I've known for years. So these are, I mean, sorry, pardon me if I'm trying to sound very simplistic, but my only concern is I don't want any of our friends to be cheated for something. It's just not, it's very, very painful and hurtful. Forget the fact that you lose your money, but it's so hurtful and emotionally you'll be hit. Next,
I think we've actually done a session or two on this. I think you're right. I think we need to do one more.
Sorry, I'm repeating. That's why I said. I mean, I'm sure you've done it.
You're right. I think we need to do this again on the ways people are conning. I think
These
in the
cons
next
are going up by the dime a dozen there.
So I know somebody who actually has studied this. Let me that in a month. We'll do these 2-3 slides quickly because we want to do question answer.
Yeah, we're running short of time. I have no problem, but you will have problem. Okay, next then. These are how you get performance, where should you get the net asset value and all this is here. I think you can read this up on the website, Saleh.
Yeah, just one thing I think is important to note. Just because a mutual fund's NAV is high does not make it a good mutual fund or a bad mutual fund.
Yeah, because that is the past, it is not the future.
Yes, it's just a number. It's a number that has to be compared to the earlier number, but nothing else. It has no other meaning. It does not, if it's 10,000 rupees, it does not mean anything.
It's like the market price of a share. Don't be guided by that.
Yeah.
Next, please. Yeah, I think this we can skip here. Yeah, now this is extremely, I mean, I said this earlier also, and I double underline, triple underline, bold letters, whatever you want. Please ensure that you have a nominee who will receive the proceeds of the mutual fund or the mutual fund once we are not there. All of us have to depart at some point in time. We don't want trouble for people, our loved ones for whom we're leaving the money for. So ensure that there is a nomination. I know one case, a top-notch broking firm and a close family member, they made investments of a 100-year-old lady, and those jokers made it in a single name without a nomination. I erupted. I said, are you daft? Why didn't you check? No, I didn't. I believe. How can I believe them? So today, they have to give an affidavit, death certificate, indemnity bond to get your own money. I mean, this is the height of stupidity. We are all senior citizens. We don't know when the good Lord above is going to call us. Without nominations, I mean, I've had a problem. My father had something in single name. He passed away, but I was able to do something. But this is, please ensure that everywhere a nomination is there. If you're a single name, no problem, have a nominee. Joint name with your spouse or whoever, child, have a joint name. Absolutely no, that is the best way out. But if you can't have that for whatever reason, have a clear nomination done.
On Monday, coming Monday, we are actually doing a very interesting session for our seniors, where not only are we going to talk about the legal aspect of nomination, we have lawyers doing this. We are actually going to write a will in front of everybody. A will can be done in 10 minutes, or actually 5 minutes. We're actually going to do that so that everybody can do a will in 5 minutes. And we're trying.
I would like to do that too. I'll attend that.
Monday at 5 o'clock, done by.
I'll mark my diary. I'll be there.
Should we?
I think, Saleh, two things. Let us do one thing. Let us open it up for questions if anybody has, or then we can look at how do you want to invest, the role play. I leave it to you all. Any questions, please? Have I gone too fast, too slow? Has something been missed out? Can you please, I mean, again, I'm repeating, please do not hesitate. I mean, I will never ever think, and I don't think any of us will think the question is too simple or too naive. No, nothing is simple or naive in this world, especially as far as financing is concerned.
So Arjun, if nobody's asking, let me ask you a question.
Please.
Can you explain to me how should one look at something called asset allocation? That word which my financial guy tells me, my friends tell me, what is asset allocation and why is it important to a senior citizen?
Okay, let me answer it let me flip the question around. For the sake of discussion, let's say you have 10 lakhs of rupees, okay? Or let's take 1 crore, 100 lakhs. Easier to divide give the numbers, okay? Now, before you do any asset allocation, I think I mentioned it last time, but again, I'll repeat it. What I would request people to do is very simply take a sheet of paper and a pen or a computer, Excel, whatever you're comfortable. Write down what are your do budgeting. Okay. I mean, I may sound like a banya, which I am, but that's a different story. But you need this. How much money do you need every month? Month is a unit which in India all of us use. How much you need monthly, and get into complete details. Okay, electric bill, medicines is the main expenses which you have today. Then domestic expenses, food, clothing, gifting which you have. Then okay, do this on a monthly. What you spend every month. Then you arrive at quarterly. What you need, let's say quarterly rent, so quarterly bills have to be paid. Then half yearly and annual. Okay. Then built in annual, you have to take care of things like insurance, your contingencies, your some annual expenditure which you may be having. All this, then you add emergency. Monthly, you add emergency about, let's say, 10% or 15%. End of the year, total figure which you get, monthly into 12, you get, let's say, 60. Then quarterly, you get another 10. Half yearly, you get another 10. So that becomes 80. 20 you get annually. Okay. 90 you get annually. So add another 10% as emergency, that it comes to 100. These are your total expenses. Okay. And as detailed as possible, you know, gas and electricity, what else? Servants, petrol, whatever, I mean, you can think of. Please put it, these are estimates. I'm not saying go to the last rupee or paise. That's stupid. Broadly, let's say servants. Servants, you can go to the detail, 25,000, let's say. Okay. Then servants' annual bonuses will come in. Medical, assume, estimate 5,000, 6,000, 7,000 a month, whatever. And then you arrive at a certain figure. These are your total expenditure. Now, how are you meeting that expenditure? From where? What is the investment income which is coming in? So hopefully you should have meeting your expenses from your income, or you have a shortfall, or you have a surplus. Once you have that, keep it aside. Then let's look at your investments. Now to meet that expenditure of, let's say, 100, correct? You need 110 every year. I'm going on an annual basis. So what should you invest in which will give you 110 every year? Now, this is broadly the principle of asset allocation. Okay. Now, so we're talking of 100 lakhs, right? 100 lakhs is your total amount which you have with you. You need, how much do you need every month? Month you need, let's say, 1 lakh, right? So you need 12 lakhs every year for meeting your expenses. I mean, I'm including your contingency and everything, right? 12 lakhs a year divided by 12, so 1 lakh a month. So 12 lakhs is the total figure which you need. On 100 lakhs, from where are you going to get 12 lakhs of rupees? No way you're going to get interest of 12 lakhs of rupees. You will get 5 or 6% today. So you're getting 6 lakhs. So that money has to, or 100 lakhs, that is all of it if you put. You can't put all of that. Okay. So you have to put money into fixed income, which gives you a regular return, number one. Number two, assuming you're less than 80, you need to put some money for capital appreciation because inflation is hitting into you. Why I'm saying 80 is because life expectancy is normally 80, 82. After 82, frankly, don't worry about capital appreciation. Whatever is there, spend it and live happily. I mean, some of us may be blessed to live up to 100 years, or maybe it's a torture these days. I don't know. But you may live up to 100, then God help us. Otherwise, plan it out. So asset allocation, a very fancy term. What it means, how much of your total investments you are going to put where? Simple, okay? To meet your objectives. What you've got a simple thing of objectives, right? I'm assuming all of us are senior citizens. So most of our major expenses have been taken care of. Major capital has been taken care of. So we need to live life for ourselves. I mean, that's what my wife and my children have been drilling into my head. For God's sake, Dad, and my wife tells me, live for yourself now. Stop thinking too much and stop worrying. You have been blessed. So we have whatever years we have to enjoy our lives. So that's what I'm trying and training myself to do, very frankly. Having worked for over 40 years, I mean, you're still not used to the idea. Though retired about 1.5 years back. I'm happy, I have no problem. But the things are, one has to allocate how much money you will need to put to generate a interest, how much for capital appreciation, and how much for emergency.
So Arjun, do you want to do a quick role play on this?
Let's say we can, why not?
You're my financial advisor and I am the person who needs advice.
Correct.
So I have my monthly expense is 30,000 without contingencies, and my yearly expense is 4 lakhs with all those annual, any additional. So 30,000 into 12 is 36,000.
That's 360.
Yes, and therefore I'm adding a little more. So 4 lakhs ka kharcha hai mera annually. Plus there may be some health issues I don't know anything about or some major event.
So let's assume 4.5 lakhs of your rupees you need every year.
I have no other income, and I am now trying to figure out what to do. What do I allocate? And let's say I am right now 70 years old, 70, and okay. Do you need to know anything else about me? Do you need to know any of my?
What I need to know is today, currently, what are your investments which you have with you? Okay.
All my money is in FDs.
Okay. Now, what you need to figure out is, are your interest returns from the FD enough to meet 4.5 lakhs? Or
No.
you have a surplus also?
No, I do not have enough money at 5%, which is the current rate I'm getting from ICICI Bank. I do not have enough money. I'm eating into my capital.
Okay. Now, this is something which is highly specialized, and you need to do with somebody whom you trust completely, or you can do on your own. See, if you're eating into your capital, how much of capital you're eating into? Now, these are figures people are somewhat not very comfortable in sharing, or some people do share, frankly. It all depends on the mindset, and more importantly, the person you're discussing this with. Okay, because if you have an advisor whom you trust completely, then you can open your cards and say, well, this is the amount I have, this is what I need, what do we do? Okay, so let's say Saleh is being open with me, right?
Okay. I have 50 lakhs as my total financial assets.
Okay. Now, the problem is in 50 lakhs, you are not going to get 25%, you are getting 2.5 lakhs. The shortage of 2 lakhs.
Yes.
Okay. Now, what I would suggest is, these are broad suggestions without getting into details. Okay. An advisor or somebody would sit with you. You can't put everything in FD. Buy some good shares, let's say 10 lakhs of rupees worth, okay, which hopefully one can double in a period, conservatively in a period of 7 years. So 10 lakhs would become 20 lakhs at the end of 7 years. You don't touch this money, right? On 40 lakhs, you are getting 5%, you're getting 2 lakhs a year. Shortage of 2.5 lakhs of rupees, correct?
Yes.
So for the next 7 years, you withdraw 2.5 lakhs from your fixed deposits.
Okay.
So it's about 17 lakhs will go. So money is by half. Or let's say I would make it, this is a bit dicey. I would make it, let's say, make it 40. Yeah, depends on what you're comfortable, 40 to 45 lakhs. Okay. Because if you're using 40 lakhs and minus 15 lakhs goes, you'll be left with 25 lakhs and that 20, so 45 lakhs. No, you're down.
So,
what you then need to do.
Let me help you with one more number. God forbid if somebody, if something, I don't have money, I can always ask my children.
Agreed. But that is.
So would you?
There are two things. No, I'm sorry, but they're just off the cuff we're discussing. So please, the audience, bear with me. I need to think. Oh, fine, we can do like this then. I would advise that put in slightly more into equity. Let's say about instead of 10, you put 12 lakhs of rupees. Okay. The 12 lakhs of rupees in 7 years would become, let's say, 25 lakhs. You have got 38 lakhs on which you're getting about 2 lakhs roughly, you assume that. So a shortage of 2.5, which over 7 years, about 15 lakhs of rupees will go. So 38 becomes 23 and that 12 becomes 24, so 47 lakhs at the end of 7 years. So back to almost square one. Your capital is the same value-wise and you've beaten inflation. It's possible that you could double your capital in less than 7 years. I am being 7 for the sake of ultra conservatism, but I think around 5 years you could double your money. Okay, so 12 lakhs becomes 24 or 25 in 5 years' time. 5 years' time, you have withdrawn a shortage of 2.5. That's about 10, 11 lakhs of rupees you have withdrawn. So 38 is down to 27 and you have 25, so 52. So about 2 lakhs surplus you have, which let's say I've spent 50 lakhs I've spent. Okay.
Arjun, I get it. So I think what we're trying to explain to people, I think what we're getting, but if
I hope this has been understood by the people. I mean, I've been just talking broad numbers in the air.
What Arjun is trying to do is saying that even though initially it looked like he cannot solve my problem, if you talk to your financial advisor, whoever it is trusted and capable and competent, the trusted is very important. The capable is the second word. You need to give him the full picture and he can actually help you live a much more comfortable life. What Arjun actually, I'm sure the next thing he's going to tell me is why should you assume 5% from ICICI Bank? Can we look at a debt mutual fund at 6%? And you get a little more.
No, today mutual funds are giving you between 5.5 to 6, not more.
Right. So you can get 5 there, right?
You need to, plan out your investment, which is asset allocation.
Right.
See, out of for 50 lakhs, you must keep about 5 or 10 in a fixed deposit in a bank for the simple reason for emergency and contingency. That's where the fastest you can get money. And liquid funds instantly. Equity shares, of course, you can sell immediately if required, but then you're hampering your capital appreciation process.
I fully agree, Arjun bhai. Anybody has any questions? We're quite.
I'm sorry, this sounds a bit esoteric or something, but as I said, there's something which needs careful thought and careful planning.
It's not easy. I completely.
It's not easy, and each one of us will have to actually sit together and then figure out what is best us. See, another thing one has to understand very clearly, are you comfortable with putting money in shares? Whether your 12 lakhs value can become 8, 9 lakhs, can become 15 lakhs also. Okay, so are you comfortable with that sort of a thing? Which is a highly personalized call.
Anybody, any questions? I know this is a very heavy session. A lot of people are trying to understand, a lot of the data that has been given. Any questions, any thoughts, any concerns, any worries? You have a guy like Arjun in front of you right now.
Saleh, I have one more suggestion.
Can I ask you? Can
One
I
second,
ask
I
you one more
just-
question?
no,
Can I ask you
no.
one more question?
Yeah, before that, I just want to say something. If acceptable to Saleh and all of you, you all can think over what we said right now, and we can do another session. I'm happy to spend some time with all of you next week or the week after. Let me know. Right, Saleh?
I'm fine with that.
Yeah, if people want it. I mean, I leave it to you. That you need the audience and you need to take a call. I'm available.
Thanks, Arjun. Yes, Jane Aunty, you were saying something.
No, you know what? I want to know, what about shares? Is it okay, or is mutual fund better than shares?
See, depends on your
Because we don't
mindset.
understand anything about shares.
No, then I would suggest go to an equity mutual fund.
Equity mutual fund. Okay.
They also give you good returns.
Yeah. Okay. Because I mean,
study-
unless we are really familiar with shares, we don't know how to do it.
Yeah, then avoid it. No problem.
Yeah.
No
Yeah.
issue.
Okay.
You can go to equity mutual funds, which will also give you
Okay.
capital appreciation.
Yeah.
See, the point I'm trying to drive home is I want the money to multiply and not remain static. Okay, your 5 should become 10 in 7 years, which is a very, very conservative estimate. But that's what I'm aiming for. Because how are you going to beat inflation? And please remember one thing, your 2.5 lakh, 4.5 lakhs of expenditure every year is going to go up. Prices are not coming down. And therefore, contingencies, of course, contingency were also accounting for inflation. You can't build in both. You either take inflation or you build in contingency. Okay, and you never know what hits you. God forbid you get some major illness tomorrow. How much of insurance do you have? I don't know. All these sort of things, the Saleh have to come, how much of medical insurance do you have? What are you covered for? What is the status of your health? Are you in reasonably good health? Are you on medication? And what sort of illnesses do you have? All of us have something or the other, right? Most common being diabetes, hypertension, and knee problems and cholesterol, or back problem, arthritis problems. These are the most common old age issues which all of us have. Unfortunately, you cannot escape from that. So what are we doing for that? Exercising and keeping fit, number one. Number two, which is more important, is mentally how alert we are, how mentally we are keeping fit. So the mind will drive the body. I'm not being philosophical. Please don't misunderstand me. Some of you are much senior to me. You have seen more of the world than what I have. But my only objective in sharing all this, please don't get saddened or get morose or something. I am not trying to frighten people, but the point I'm trying to drive home very simply is that one needs to be vigilant, one needs to be aware, and one needs to be prepared in life. And all the money and effort which one has put in over the years, one has to ensure that it gives you comfort at this age. You're not going to take the money with you. Okay. I mean, there are other drastic schemes available, something known as reverse mortgage. Okay. So, I mean, not taken off in India, but it is something which some people have explored. Let's say you have a flat which you're staying in. Value is 1 crore. Arbitrary figure, or 2 crores or 3 crores. Let's take one for the sake of discussion, you can always multiply it. So what you do is you pledge it for 15 years or 20 years. So for 15 years, the company or the firm will give you X amount of money every year on your flat. After 15 years or 20 years, the flat reverts to them. It becomes theirs. There is something known as the reverse mortgage concept. So I have an asset.
Arjun, that's not yet taken off in India. I spoke to ICICI.
It's not taken up. It's not taken up.
There are issues there, the product issues, which actually make it useless for senior citizens.
Yeah, there are legal issues. If God forbid you live more than 15 years, what happens?
Exactly. There's some issues.
All those things have not been sorted out.
Yeah.
But these are some things which are coming up. And the other thing is also asset allocation is we are only talking of financial assets. Now, do you have gold? Do you have property? Do you have another flat? Do you have some land somewhere? All that. And I would recommend senior citizens don't count the place where you're staying in. That is irrelevant. You'll be on the street. You cannot count that as an asset. That is a given. You need it. You're staying there, period. That's it. That figure, whatever the value may be, don't even look at it. Unless it's obscenely huge and you don't need it, then you sell and move to a smaller place. But again, moving to a smaller place has its own problems. Your life, you've been used to having a large house and all, so the mental shock is also there. You know, all these things come into play. It's very difficult to generalize, but at this age, we have to realize that you have been set in your ways for some time. It's not easy to change at any age, especially as the more set we become. So are we happy doing those things? We want some things in a certain way. Suppose they change all of a sudden, what are you going to do? You know, I'm sorry, some of these questions may sound a bit morbid, but I think this is the harsh reality of life. One has to accept that.
Does anybody have any other questions? 2, 3 things that are coming out from what Arjun is saying. Number one is that, you know, we have to make our money work for us intelligently. Number 2
Without
is
doubt.
And we need to take action. At times, you know, we just keep on delaying it. I think once you have some knowledge, a bit of research, and I think, you know, the next time that Arjun and has this talk, we're going to do a very practical session, no more theory. How do you research a mutual fund? You know, on the net, how do we do that? Let's teach you that. The second thing I'd like to tell everybody is, in case you guys want to know what other assets you have, on the TAARE website is under downloads. We actually created this about a year ago, a list, an Excel sheet where you can think of all your assets in a different way so that you can have that at the same place. Maybe look at that as another option. And let's wait for our next talk on this so we can build on what we've learned today. If anybody has any questions, let's ask right now. I need to end. It's been, we've taken nearly 1 hour plus of Arjun's time. And we're
No problem. But I think what we need to, obviously, everything has an expiry date, an expiry time. So, I mean, any questions, you can mail them to Saleh, you can give it to me or whatever you have. But please think about these seriously.
Thank you very much.
These are harsh realities.
Yeah, it's an interesting thing, right? I mean, there are solutions.
And once again, I mean, I apologize if I've sounded a bit morbid or tried to say something which should not be there, but I guess I had to, you know, mention some things to you.
It's a call to action, Arjun. Thank you very much. And that's very important.
Yeah.
Call to action.
Sure.
Thank you very much, everybody. We're going to end this session. Again, thank you very much, Mr. Bhai, for this. I know you're a person who of yours with so much of experience coming and talking to us on this. It's invaluable. Let's use this.
It's my pleasure.
Let's convince him to do more with us. Thank you.
It's my pleasure. I mean, whatever way I can.
Arjun. Thank you.
No, you're most welcome. But please do think about all this. That's my only suggestion to you.
Yeah. Thank you.
Thank you. Bye-bye.
Thank you, Saleh.
Bye.